Good morning, good afternoon, good evening, ladies and gentlemen. Welcome once again to our episode on the finance, on the investment. This is the world of investment, how to invest. So this is a third episode. We're going to look at the number 2, learn the basics of different investment types. So we talk about different investment types of financial investments, which are like stocks, bonds, commodities, and all the assets and other assets. So I'm going to break them down really and try to explain them in depth. So the first video was just to give like the iceberg, the top of the iceberg. Now I'm going to get really into details. So what we're going to learn really, it will be like the type of of assets or investments. The first one we look at the stocks, which are equities. The second one we're going to look at bonds, which are fixed income. The third one we look at the mutual funds. After that, we're going to look number 4. It will be on the exchange traded funds, the ETFs. Then number 5, it will be on the real estate, like buying a rental house and things like that. Number 6, it will be on commodities. So when I say commodities, do you know what I mean? What are commodities? So I'm going to break all of that down in this video. Number 8, I'm going to touch on the cryptocurrencies, cryptocurrencies. Then I'm going to give a quick summary at the end of the video, just to summarize really what we learn, just as I usually do in all the videos. So are you ready, ladies and gentlemen? Tighten your belt, including mine as well. Tighten your belt and let's begin. So we are on the third episode, like learn the basics of different investment types. So now you have to begin your investment journey. So let's begin. So once you have established why you want to invest, it is crucial to understand the different types of investments available. That is when you have taken the decision, it is crucial to understand which one are available and which one are suitable for you. Like each type comes with its own risks, return potentials, and role in your portfolio. There's a risk, return potentials, which are like the rewards as well. And you roll like you roll in your portfolio. Like a portfolio simply means financial investments, different financial investments like stocks, bonds, and other assets like commodities. So I'm going to give an overview of the most common investment types along with practical examples to help you grasp the basics. So always put more emphasis on practicality because you cannot learn without examples. So examples are much better to explore your imaginative part. Not only to keep everything logical, we have to touch on the imagination as well. So number 1, we should touch on the stocks, which are equities. So what are stocks? What do I mean when I say stocks? So this is simply the basics one. So if you're more advanced, I think you can jump or you can wait. Maybe there will be some surprises in this video or episode. So what are stocks? So when you buy a stock, you are purchasing a share of ownership in a company. So when you buy a stock, you're purchasing a share of ownership in a company. So you become a stockholder. So stocks offer the potential for high returns, but come with high risks due to price volatility. So high returns, high risk as well. So it's like taking high risk, so high jump. So for every action, there's an equal and opposite reaction, according to Newton's third law of motion. What goes around comes around. You reap what you sow. So high risk comes with high returns as well. So how they work, how do stocks work? So the value of your stock investment fluctuates like up and down, depends up and down, like in marketing. So when you're talking about marketing, it goes up and down, up and down. When the price goes up, you give an excuse for the price to go down. When you lower the price, you give an excuse to raise up the price, to increase the price as well. There's a fluctuates with the company's performance and the market conditions. So if the company does well, the stock price generally increases. And you can sell your shares for profit. That's how stocks works. Like conversely, if the company performs poorly, in the second case, the stock price may decrease, leading to a loss. So ladies and gentlemen, that is how stocks works. If the price goes up, if the price increases, then you can sell your shares for profit. But in the case when the company does poorly, like when the price decreases, then the stock price also may decreases, leading to a loss. That's how it goes with the profit and loss. This is all about gambling, really. You profit today, maybe you lose tomorrow. So the quick example on the stock, like you buy 10 shares of a company at €50 per share. So I'm going to use euro, not pound or dollar. So if the stock prices rises, let's say to 75 euros per share, your investment grows from 500 euros to 750 euros. So just 50 by 10 or 75 by 10, which gives you 750 euros. However, if the price drops, let's say to 40 euros per share, your investment decreases to 400 euros. That's how stocks works. So the role in portfolio, we said portfolio just a financial investments like stocks, bond, and all. So in this case, we're simply talking about stocks, the equities. So the role of for stock, like in the portfolio, the role in portfolio, like stocks are typically used for growth, especially like in the long-term portfolios. So if you're focusing the long-term portfolios, then stocks is a good choice for you. Number two, we're going to touch on the bonds, which are fixed income. In the case of fixed, meaning if you're given like 5% interest, it will be fixed. Do not be up and down, like fluctuations of market. Just stay on 5%. So in the case of bonds, which are fixed income, so let's say fixed interest rate, like at a fixed interest rate. So what are bonds? When I say bonds, what do I mean by bond? Or what do we mean by a bond? So bonds are essentially loans you give to a government. Let's say to a government. If you loan a government, there's a bond. Like let's say municipality or corporation in exchange for regular interest payments, and the return of the bonds is face value when it matures. So those are like the bonds. So when you give a loan to a government, municipality or corporation in exchange for regular interest payments, and the return of the bond is face values and when it matures. So when it matures, then you start getting some income. That's how bond works. How they work. So when you buy a bond, you agree to lend money for a specific period. In return, you receive interest payments like coupon payments over the life of the bond. So in the case of a bond, it's like over time, which is a lower risk and lower return as well. So once the bond matures, you get your initial investment back. So the initial investment is like the money which you put in, the input. So when the bond matures, then you get your initial investment back, maybe with some interest on the top as well. So the example, let's give a quick example, practical example, so that you not fall behind. So let's say, for example, you buy, like, let's say a 1,000 bond, 1,000 euro bond with a 5% interest rate and a 10-year maturity. So the 10 years like the time span at 5% rate, which with 10-year maturity. So you'll receive, let's say, 50 euro each year in interest payments. So in those 10 years, you receive 50 euro each year in interest payments. So at the end of 10 years, you will get you 1,000 euros back. At the end of 10 years, that's when you'd get 1,000 euro back, you input back. So the role in portfolio, like bonds, are generally used for income and stability because the return is more stable and they are lower risk as well. So they're used for income. They're generally used for income and stability, like balancing out the higher risks of stocks. So if you're more cautious, then bonds are a good choice for you. But if you're more adventurous, like the young people, more daring, then you can go for stocks, which have higher return as well on the investment. So number three, we're going to look at the mutual funds. So in the case, what are mutual funds? What do I mean by mutual funds? Or what do you mean by mutual funds? Or when someone says that, what does that mean? So mutual funds pool, the POL, the pool like swimming pool money from many investors to invest in a diversified portfolio of stocks, bonds, or other securities managed by a professional fund manager. So in the case of mutual funds, you need a professional fund manager, someone who's doing it for you. If you lack the knowledge, they will be doing all the investment for you, guiding you through. So just give them money, then they will be taking all the pain for you, really. That's all about mutual funds. So how they work? So when you buy shares, let's say, of a mutual fund, you are buying a small piece of a larger portfolio. So the fund manager makes the investment decisions for you. So just sit there watching while the fund manager makes the investment decisions, and you benefit from the diversification, which reduces risks. So diversification is simply like the spreading, really, like the practice of spreading investments around. So that's all the diversification, just spreading out everything, diverse, like. So in the case of diverse land, it's like spreading. Concave is like focusing in. So the example, let's say the example, like a benefit from diversification, which reduces risk because I've got the fund manager there. The example would be like you invest, let's say, 1,000 euros in a mutual fund that holds a mixture of 100 different stocks. So in this case, you're not only investing in stocks or bonds, you're investing in 100 more stocks. So if one stock performs poorly, the impact on overall investment is limited because of diversification, because of the spreading all over. Instead of risking all your money in one stock or one bond or one investment, you try to spread them all over the places. If one of them fail, then still have high chance, let's say 90% or 80% of getting your money input back, the investment back. So the role in portfolio as well of mutual funds, like mutual funds are often used by investors who want diversification and professional management without picking individual stocks or bonds. So in the case of mutual funds, they're simply used because if you don't want to pick individual stocks or bond, use diversification, just spreading all over, you spread your money all over. It's like playing lottery, you try to pick this and this and this, or investing in different departments, different asset classes. Like instead of just the healthcare, you can go maybe in the tech as well, tech companies. So number 4, we're going to look at the exchange traded funds, the ETFs. Exchange traded funds, ETFs. So what are the ETFs? ETFs are similar to mutual funds but trade on stock exchanges like individual stocks. So we saw that in the first episode. So when I gave just a quick detail, now we're going deep inside, we're delving deep inside. So they often track an index, the ETF. They often track an index such as the S&P 500 and can offer diversification at a lower cost or at a low cost as well. So how the ETF works? So when you buy shares of an ETF, you are purchasing a small piece of all the assets the ETF holds. So when you just buy shares of an ETF, you're purchasing a small piece of all the assets ETF holds. So ETF can be traded throughout the day, just like stocks, and often have lower fees than mutual funds. So the ETF have lower fees than the mutual funds, meaning the investment, really, the fees which you'll be paying, let's say at the end of the day, at the end of the week, at the end of the month, are lower than the mutual funds. But in the case of mutual funds, you try to spread them all over the places. That's like the advantage. The pro or the con, so have pros and cons. So the example of the ETF, so let's say if you buy shares of an S&P 500 ETF, you're investing in all 500 companies that make up the index. So if the index rises, let's say by 10%, your investment in the ETF also grows by 10%. If it rises by 10%, your investment also in ETF grows at 10%. So it's like proportional, really, simultaneously. So let's say the role in the portfolio of the ETFs. So ETFs are versatile and can be used for growth, income, or a mixture of both, depending on the specific ETF. So number 5, we're going to touch on the real estate, the one which you're common with, like buying real estate, investing in real estate or stocks. Those are like the common one, which most of people are acquainted with, really. So what are the real estates, or what do we mean by real estate investing? So real estate investing involves like purchasing property, which can be like residential, commercial, or industrial, like to generate rental income or to sell at a high price later. You can buy a property, a house, a rental house, commercial, like a company, or industrial, something like that. Like you can, if to rent out, in the case of to get income flow at the end of the week, at the end of the month, or to sell, at a higher price later on, really. So how does the real estate works? So you buy a property either directly or through a real estate investment trust, the REIT, which is a real estate investment trust, REIT. So you can earn returns through rental income, like per month, per week, like appreciation in property value when the price goes up. Appreciation is when the rises in price of an asset. Depreciation is when the price goes down or decreases. So you can earn returns through rental income, appreciation in property value, or both. So the example of real estate, it will be like you purchase like a rental property, let's say for 200,000 euros, and rent it out for 1,500 per month. So over time, if property values in the area rise, you can sell the property at a profit, or the 1,500 per month, that'll be like your income as well, which you're getting out of rental property. So the role in portfolio as well of the real estate. So real estate provides income and can serve as a hedge against inflation. So what is inflation? It's just the rate of increasing prices over a given time. There's inflation, the rate of increasing price over a given time. So it is often seen as a more stable and long-term investment as well. The real estate can be qualified as a long-term investment. So when we talk about long-term, there'll be like 10 years plus. So number six, we're going to look at the commodities. What do we mean by commodities? So what are commodities? So in the case of commodities, are physical goods like gold, silver, oil, and agriculture products. So all of those qualify as commodities: gold, silver, oil, agriculture products. Like investing in commodities can protect against inflation and provide diversification. So we said inflation is just the rate of increasing price of a given time. So in the case of gold and silver, they are known as the coin of the realm, which are gold and silver. They are known as the coin of Rome. That is special in gold and silver. So how does the commodity works? How do they work? Like you can invest in commodities directly by buying the physical goods, or indirectly through future contracts like ETFs as well, or commodity focused mutual funds as well. That's how they work. Like the example, if you buy gold, let's say 1,500 per ounce, and its price rises, let's say, to 1,800, your investment has increased in value. So you have like 300 euros difference in increase, because you bought it at 1,500, now the price has risen to 1,800. So your investment has increased in value. Like commodity are often influenced by, like, let's say, by global supply and demand factors as well. Those are the two things which can influence the commodities: global supply and demand factors, some demand factors. So role in portfolio, like commodities can add diversification and act as a hedge against inflation and economic uncertainty. Number 7, I'm going to look at the index funds. The index funds. So what are the index funds? So index funds are mutual funds, or the ETFs. ETF is just exchange traded funds. Those are the ETFs that aim to replicate the performance of a specific market index. To replicate or to try to copy, really. Replication is like trying to copy or try to imitate the performance of a specific market index, such as the S&P 500. So how does the index funds work? So when you invest in an index fund, you're investing in all the companies in that index, which spreads risk across many companies and sectors. So it's like the mutual funds as well. Instead of just betting on stocks or bonds, you try to spread them, diversification, spreading all over the places. So you're reducing the risk as well. So the example, if the S&P 500 rises by 80% in a year, your S&P 500 index fund should also increases by roughly, let's say, 80% minus any fees, which you're going to pay like at the end of every month. So role in portfolio of the index funds. So index funds are popular for their lower costs, which is good. The benefit is just a pro. Diversification, which is like similar to mutual funds, like spreading your investments all over the places, around the places, which is good as well. And simplicity as well, like making them a favorite choice for long-term growth income for our investors. So for the people who are focusing long-term, like 10 years plus, the index funds is a good choice as well. So they have low cost, diversification, and their simplicity as well, and which makes them a favorite choice for long-term growth investors. Now, number 8, we're going to cryptocurrencies, or crypto, the famous one. So I've got a website here as well. You can go check the www.investopedia.com. So it is INVESTOPEDIA.com. That's the website. So they simply give like definitions and different terminologies about investment in business, anything related to market or business world or investing world as well. So in the case of cryptocurrencies, what are cryptocurrencies? So cryptocurrencies like Bitcoin, like the Ethereum, are digital or virtual. Virtually cannot be touched. So virtual currencies that use cryptography for their security. They use cryptography for their security. So they are like decentralized and operate on blockchain technology. So if you've never heard about blockchain, I don't think cryptocurrency is good for you. So blockchain is like complicated technology really. So how they work, like the cryptocurrencies can be bought and sold on various exchanges. Like their value is highly volatile, like it depends, it's changeable really, like driven by supply and demand as well. So if there's more supply, then the price will go up. But if the demand is higher, then the price will go higher as well. If more people are asking for them, the price will go higher because there will be scarcity. There will become few of them only in the market. So maybe it can be regulatory news, like some news, someone might come like Elon Musk and say, oh, this and this, then the price will drop as well, decreases. And the market like sentiment as well. Market sentiment can also vary, like can also affect the cryptocurrencies as well. So the example of cryptocurrency, like if you buy, let's say, one Bitcoin at 30,000 or 30k euros, and the price increases, let's say, to 50,000 euros, your investment has grown by 20,000 euros. However, this is a point to keep because the prices is always high. Imagine one Bitcoin at 30,000. Now the prices goes up to 50,000. So I've got like an increase of 20,000. Different like investment of 20,000 already, like the profit. However, if the price drops, you could face significant losses as well. So it is not all about winning, gaining. It's gain and loss, risk and reward as well. So the role in portfolio of cryptocurrencies, like they are highly speculative and are often considered a high risk, high reward investment. There's a high risk, high reward investment, high reward as well. So the high return at the same time, like stocks, but these are more higher, like higher. The risk is more higher than the stocks in the case of stocks. So they can provide like diversification, but should generally be a small portion of your portfolio. This is just an advice. So there can diversification, simply making really spreading your investments all over the place, around the places, but it should generally be a small portion of your portfolio. So you can simply focus maybe, let's say, 10% on the investment on the cryptocurrencies, the other 90 or 80%, if you put 20, 80% you put maybe on stocks and bonds as well, or index funds or mutual funds. So try to spread them like that really. That's all about trying to understand how the investment types, like different investment types. So whenever someone talk about cryptocurrencies, now you can talk about the blockchain technology. Now you know what that means. You know the Bitcoins or Ethereum, they're all like virtual currencies which cannot be touched. They're like in the computer, you cannot touch inside it. They're not physical, they're virtual, imaginative, something like that. But they're being encoded or encrypted. Security really. So what can we say in conclusion, ladies and gentlemen, after many types of investments, the types of investment, stocks, bonds, index funds, mutual funds, cryptocurrencies, now we're touching on Bitcoin, we're touching on Ethereum, and many others like the ETF, the exchange traded funds. So in summary, like learning the basics of different investment types is essential to building successful investment portfolio. Once you have the basics, once you understand the basics, then we also build a good foundation so that will not be taken by the first wind or the first storm. Like a tree, the ones which grows so fast, it will be taken by the first storm. So in your case, you're taking baby steps, you're building the strong foundation in this case. So each investment type serves a different purpose, from growth to income to diversification. So by understanding our stocks, bonds, mutual funds, ETF, the exchange traded funds, real estate, commodities, index funds, and cryptocurrencies work, you can make informed decisions that align with your financial goals and risk tolerance. So we talk about the risk tolerance. How much can you bear to lose? How much can you afford to lose? How far can you afford to go? So start small, diversify your investments, and continue learning as you go. So ladies and gentlemen, what was your day? Well, I think that's the end. So don't forget to like, comment, subscribe, and keep sharing the video to other people who really are interested in investment. We live in the age of Aquarius now, the age of information, the age of exploration. So don't try to be just behind think about investing as well in the future. If not for yourself, maybe for education for your child as well. So what was the biggest takeaway from this video, ladies and gentlemen? Or did you learn anything new from the video? Or what was the favorite part of the video? So leave your comment. Don't forget to leave your comment. Don't forget to share. And keep subscribing as well. I want more subscribers because we want to hit 1K or try to hit the watching hours as well. So thank you for watching. Ciao. Bye.